Intel was hit very hard on Thursday or Friday. And I loved the comments coming in because the comments showed me that no one is a long-term investor. Most common comment, why can't you just admit you were wrong? Guys, I've admitted I was wrong on Amazon. It takes years to realize if the path actually occurred or not. So you're gonna sit there and say, Paul, say you were wrong. If that's what you're looking for on any sort of investment, here's the proof in the pudding. I literally get emails and messages on our software all the time saying, Paul, thank you so much. Because of you, I made this investment 3 months ago and it worked out. And what do I respond with? Every time I say, this is too short a time frame to give me credit. So if I'm willing to say that when things go in my direction, you better believe I'm not going to say it when things go against me. What I'm going to do is I'm going to be a long-term investor. I'm going to reassess at all times. Now, what happened with Intel that caused me to reassess? The revenue dropped 17%. Holy cow, nobody was expecting that, including me. Okay, great. Does that mean I'm wrong right now? No. Does it mean I'm more likely to be wrong? Yes. That's why I said I need to reassess. Other comments I'm seeing, see, Paul, AMD is the way to go. If you think that Intel's results are a justification for AMD being the way to go, please take your money and piss it away because you don't understand investing. What you're saying there is, I don't care how much AMD is, I will buy it because it's better than Intel. Spoiler alert, AMD's chips are better than Intel. I believe this. I split up the company from the stock price. If you don't do that, you will underperform in the long run. That's an absolute fact. Now, do I think I'm right on Intel? I don't know. And I've always said that about every single one of them. I've always said about every single stock I talk about, I don't know if I'm right or wrong, but my goal is to find 20 to 40 companies that fit my criteria. And I've said in my 1,600 plus videos, I will bet anything on it that I've said, you're going to be right on some, you're going to be wrong on some, and a lot of them in the middle will do pretty well. That is the goal. Charlie Munger talks about Berkshire Hathaway. His comment has been, we've had a few very good companies do extremely well. The rest of them probably did about average. They've had write-downs. I will never, ever apologize for my process and for being wrong based on my process, ever. Because at the end of the day, it's about evaluating businesses where they're at and say, if I were to sit here, it's like sitting there saying that Derek Jeter shouldn't be along in the Hall of Fame because he didn't get on base 70% of the time he went to the plate. Are you kidding? Are you kidding? That's a ridiculous statement. That is an absolutely ridiculous statement. So if your goal here is to just sit there and say, Paul, you're more power to you. Why are you watching the channel then? But the whole point is to learn a process. If you're new to this channel, I'm Paul, I'm a value investor. My goal is to evaluate companies and determine if I think there's more upside potential than downside potential. Does that mean I'm gonna be right all the time? Absolutely not. But the last time I checked, what did AMD hit a high of and what was their low versus Intel's high and low? Much more narrow. So I want to sit there and say that proves the point that AMD is overpriced and overhyped. But I'm going to evaluate both companies today. Let's start with Intel. So we're going to go to our software. We're going to pull up Intel. Now, I want everybody to realize the chip market has a future compounded annual growth rate potential of 12.2% a year for the next 10 years. That's a huge number. And I'm hoping Intel can ride that wave with them. Okay? So we're looking at Intel. Let's look at the 8 pillars real quick. Now, what do we have here? Okay, we have a lot of green checks and one big X, free cash flow. But we know why the free cash flow is down a lot. Why is it down a lot? Because they're investing into their company big time. They've already announced this. They said free cash flow is going to get hit and it's going to get hit big because we are going to invest in the company because we have AMD and they have a great chip. We need to compete with that. They're building 2 mega factories and this new act with Congress is going to help Intel big time. It's going to help a lot of chip companies at big time. They want to build chips in the US. All right. Does this mean go out and buy? Absolutely not. But I'll tell you right now, more times than not, I'd rather buy a 7 PE and a 10 free cash flow than a 78 and 107 free cash flow. So speaking of which, let's go pull up AMD. AMD. Isn't that ironic? 96 times earnings, 130. If you think just because they make a better chip that this is justifiable, you don't understand investing. And you are going to do very poorly in the long run. You might be right on AMD, but if you're so right on AMD and they're so much better, why is their stock high in 52 weeks, 164, and their low is 73? That's less than half. Intel's like 55 to 36. If you just care about short-term results, doesn't that tell you that Intel is better? I'm not saying it is, but using your logic, it says that Intel is better because its high and low is so much better. That's the point, guys. That's a ridiculous statement. And just like I say to people who give me credit in the short run, wait for the long run. This is a process-driven enterprise here. We're sitting here and investing, trying to apply the same things to 20 to 40 companies and hopefully be right in the long run, better than the market. But if your results are just purely driven on what I could very well be wrong on Intel. The 17% drop definitely concerned me. I have to reevaluate. But guess what, guys? Guess what percentage of my portfolio is Intel? Less than 1% of my portfolio. No, about 1% of my portfolio. That's the point. I've heard people say I had 10% of my portfolio in there. Why would you have 10% in any company? You don't understand them well enough. So when we're looking at this, let's go look at Intel's future. And let's look at the our stock analyzer tool. So let's make some assessments for revenue growth. Let's assume -2, 0, and 2%. Profit margin. Let's assume 18, 20, and 22. And guys, by the way, I've done so many videos in this. My assumptions change every single time. Every single time. I just do it here off the cuff. Free cash flow margin. I'm going to do 18, 20, and 22%. PE, 8, 11, and 14, 8, 11, and 14, and a 12.5% return. Analyze. The stock's currently at 37. Okay. On the high side, 47, low side, 25, middle side, 33. All right. Guess what? These are much lower assumptions I was making in the past. I had changed my revenue growth assumptions based on recent data. Okay. So I sit there and say, is this bad? Okay, it's not great. But let's go to AMD now. Let's look at everybody's poster child. Because you got to remember one thing, guys. When you tell me in the comments that AMD is better, you are saying, I don't care what price AMD is at. I'm going to buy it just because it makes better chips. And that's a great process if you want to lose a lot of money. Go look at every bubble in history and every single asset. It was based on hype. And they started out with a very logical thing. AMD has better chips than Intel. Price goes up, and it never ends. So let's look at revenue growth from AMD. Let's go with 10, 15, and 20%, which, by the way, 20% revenue growth is insane. Let's just show you how insane it is. They did $19 billion last year in revenue. So they do 20% a year for 10 years. Yeah, it's not terrible. $120 billion in revenue. It's possible. Profit margin. Let's go with 14, 18, 14, 17, and 20. Free cash flow margin, 14, 17, and 20. PE, it's at 40 right now. I'm going to call it 40, which, by the way, I'm putting a 14 PE here. What did I put in for Intel? Just remember that. 14, 16, 18, 14, 16, 18, and a 12.5% return. And by the way, okay, so here we go. 130, 37 is the low, 71 is the middle. Okay. AMD is getting better and it's getting closer to the price target that we want. But it's got to grow 20% a year to justify today's price. 20% a year. And it's got to have margins and a PE of 18. The bigger and bigger it gets, the lower the PE is going to be. If this is your idea of a great investment, go right ahead. And you might be right. But if you apply this exact same thing to 100 companies, you are going to do very poorly. That's what investing is. Tomorrow, AMD reports earnings after hours. My expectation is revenue is going to be huge and profit's going to be huge, which is in line with what they're going to do. And the stock is probably going to go up from here. Why? Because that's the way it does. AMD is crushing it. But you've got to remember, there's a difference between a company doing very well and overpaying for it. Separate the stock from the company. If the company crushes it and the stock goes to unfathomable levels, it's still a bad investment. You have to remember that. And if you don't realize that and you're over the age of 40, you clearly didn't pay attention to the dot-com crash. You clearly didn't pay attention during the financial crisis with real estate. And you're not paying attention right now with these high-flying stocks. Go look at Coinbase, all these hype stocks that occurred in the last year that have fallen. Intel will probably go down over the next year as the NASDAQ goes down. But guess what? My guess is AMD will probably go down even further than Intel from a percentage standpoint, as is evidenced by their highs and lows of the year. AMD's is much bigger drop on the high versus low. Why? Because it's more overpriced. So if you want me to sit there and say I'm wrong, unsubscribe from me. I will say I'm wrong 5 years from now when the whole thing plays out. Just like I did with Amazon. Just like I did with Google. I'm doing that now with Google. I thought Google, after the stock split, was originally worth about $40 a share. And now I've adjusted it to about $120 a share. And it's much higher than that right now. As time goes on, the fundamentals get better, my price adjusts. If you just follow a company based on, I like this versus I like that, you're going to do poorly. I'm sorry to say that to you, but it will happen. And if you still want to hate on me, bring it on. By the way, I respond to comments sometimes. I laugh. They don't affect me one bit. That's the key about being a value investor. At all times, you're unpopular. When stocks are up and you're not buying, you're unpopular. When stocks are low and you're buying, people say, look how stupid you are. You're buying these stupid stocks. I'm fine with that because guess what? At the end of the day, I believe my process will lead to better results over a long period of time. That is evidenced by the fact of find me one fund manager who killed it in every bubble who's still around today. You will never find that. Kathy Wood is an example. She'll be gone in a few years. Thank you very much for this time. If you happen to like what I said, please subscribe to the channel.